Welcome to Raghunandan Money. By now, you must be clear about the difference between the primary market and the secondary market. Today's video focuses on what an IPO is and how it works. Companies need funds for growth and expansion. Companies can raise funds either through debt financing or through equity financing. Debt financing, for instance, bank loans, is where the company needs to pay back the amount borrowed and the interest. Equity financing, like venture capital, angel investors, or stock market, is where the principal amount is not returned nor is the interest paid. Under equity financing, the company shares a part of the ownership with the investor in return for the funds raised. The stock market is where any individual, rich or poor, can buy the shares of a company in return for ownership. For companies, the stock market is a place to raise funds from the public. All the companies present in the stock market have raised funds from the public and hence are called public companies. Initial public offering or IPO allows companies to raise funds for the first time from the public in return for ownership rights. In an IPO, the transactions take place directly between the investors and the company. The ownership that an investor receives from the company is directly proportional to the number of shares purchased. When coming up with an IPO, companies with investment banks decide the share price or price band. An IPO is open for a period of 3 to 10 days for investment. Usually, it is open for 3 days. Within these 3 days, the investors need to subscribe to the shares of the company. Once the shares are subscribed, they are allotted to the investors. In an IPO, investors can only buy and not sell the shares. To sell the shares, investors need to wait for the shares to be listed on the stock exchange. After a few days of allotment, when the shares are listed, they can be sold and the interested investors can buy these shares. When an investor sells the shares brought in an IPO to another investor, the ownership rights are also transferred to the investor purchasing the shares. A stock exchange is a place where buyers and sellers come together to buy and sell shares. Investors can gain up to 50% from their investment amount provided they choose the right IPO to invest by investing in the IPO. We hope this video was useful to you. The upcoming videos will discuss in detail how you can start your stock market investment journey. For more, visit www.rmoneyindia.com. Don't forget to hit the like and subscribe button if you liked the video.